Welcome to the Real Estate Pros Show, where we interview real estate investing professionals from coast to coast, as well as the service providers that serve the real estate investing industry. Our goal is simple: share what's working now to help you improve and scale your business to the next level and meet the pros that can help you get there. Real Estate Pros is powered by Investor Fuel, America's leader in helping real estate investors and professionals build the business you need to live the life you've always dreamed of. Let's start today's show. Property insurance for real estate investors doesn't have to be difficult, but it does need to be there to protect you when you need it. MyInvestorInsurance.com not only provides insurance at 15 to 30% cheaper than traditional agencies, it's built specifically for real estate investors like you. You can set up an account in about 2 minutes, get quotes on properties, turn on and turn off insurance for your fix and flip or rental properties in around 2 minutes without having to talk to anyone directly, all through our portal. There's no better way or faster way to make sure you've got the coverage you need to protect you, and no more lengthy policies either. Once you're set up, you're billed monthly and prorated by the day for however long your policy is active. It's powered by MSI, the third largest independent MGA, with 1.5 million customers and more than $1 billion in cumulative premiums written. Get set up today in about 2 minutes at myinvestorinsurance.com/fuel.
Welcome back to the Real Estate Pros podcast. I'm Kristen Knapp, and I'm here with real estate fund manager Mike Zlotnik, CEO of TF Management Group, LLC. Thank you so much for coming here, Mike.
Thank you, Kristen, very much for having me.
And also, we can call you Big Mike. That's your nickname.
Yes, cheesy nickname. I am 6'4", so.
Big Mike. That's easy to remember. We'll do that. But thank you for coming here today. You have such an interesting background. Can you tell everybody just about your journey to where you're at today?
So I'll run a very short version of it. I'm like James Bond movie was From Russia with Love. I come originally from Moldova. It was still Soviet Union when I left in '89. So I'm from Moldova with love, right? So I came here. I'm U.S. educated. I've lived here, obviously, U.S. citizen, U.S. patriot. I live in Brooklyn, New York, with my family. I have a lovely wife, 4 monkeys and a cat, 4 kids and a real cat. Mathematician by education, spent 15 years in technology, realized my passion was real estate. 2009, I switched to real estate full-time, kind of circumstantial. I had a successful career in technology, but really I had a passion for real estate, so started real estate full-time 2009, never looked back, love it, and that's my journey.
That's awesome. I love that. So you are just the go-to guy for, making deals and making all that happen in this landscape. So I would love to know, what does a great deal look like today?
Sure. So obviously, this is a very changing live statement. A few years ago, great deal was very different versus now. Today, truly, you can appreciate fundamental underwriting, conservative thinking for deep value real estate. So today, the way I look at most of the commercial deals, they're different for residential. Of course, residential applies a little bit different rules, but on commercial ones, you could buy at a capitalization rate meaningfully higher than the cost of money. A few years ago, it was sort of the opposite. People paid very low cap rates. Now the market shifted drastically. The prices and valuations significantly discounted. So we've seen deals with the cap rate spread between the purchase cap rate before any improvements, before any additions, and any value you can create of 200 basis points or more versus the cost of money. That's the beauty about it today. And then you can look at the other metrics like reconstruction cost. You're buying at, let's use an example. We did a deal in Q1 for $79,000 a door. Your reconstruction cost is approaching, let's just call it $200,000 a door or $180 a door. So you're buying at a steep discount to reconstruction cost. Then you look at the safety of the cash flow, what kind of leverage, and then you start looking through these very classic characteristics. And another way to look at this is how much price is retreated from the peak of the market. Now, that's all relative, right? But in a deal that we closed in Q1, we bought multifamily at $79,000 a door, and it traded at about $125,000 a door. It's 35% off the peak of 22, let's just call it. So you look at multiple of these metrics. It's no right or wrong. did you get 30% off or 35% off? Materially, it's less concerning because you're buying at a positive spread, you have conservative leverage, you got cash flow from day one, which is another very important element that people forgot a couple of years ago. The cash flow was a secondary consideration. Today, you can get a deep value buy, and the deal could be an income deal, as crazy as it sounds, because you're buying so deep today. So this is just an example of a deep buy in multi. We're doing another deal right now in open air shopping where it's being bought at a 9.25 cap rate, and it's being financed at 6.5 fixed rate debt. So it's a 275 basis points, 2.75% positive spread, which basically creates a ton of cash flow. And that deal, the crazy part is only has 57% leverage.
Stop living on an island and join the #1 mastermind in America for professional real estate investors. Investor Fuel is a community of hundreds of the nation's top investors working together to build stronger businesses and better lives. In addition to the amazing community of real estate investors acting as a board of advisors for one another, Investor Fuel members have access to 100% funding on purchase and repairs for our members only, a health insurance program, and benefits and discounts that more than pays for the membership of most of our members, meaning it's actually costing you money to not be a member of Investor Fuel. If you're looking to scale your business and build a business that allows you to live the life of your dreams, please visit investorfuel.com today and book a call with our team.
So when you think about it, your downside protection becomes so high, and you buy it so right that you have a lot of upside, and you are protecting yourself. So that's what I consider to be a deep buy, this is how you there are no guarantees in life, right? But you have an asymmetric return profile where your downside is very small. I mean, things could go wrong, right? Theoretically, but your upside is very, very significant because you can also lease up units, you can improve rents. On that deal, we're buying with 84% occupancy. On top of all that, it's 84% occupancy and 9.25 cap rate based on 84% occupancy. All these things, just basic math, points to a strong deal.
And I love your philosophy of precision over volume. If you want to talk a little bit more about that.
Sure. So, yeah, years ago, people just did momentum buying, and they just bought a deal, and then the next deal, and the next deal, and then they bought more than they can chew. They overpaid, and that was the reality of the world. Unfortunately, a lot of people were in that situation. Today, it's just, you can't buy in volume and get great deals. So you have to find a motivated sell situation. Every deal, it's got to have a story why the seller is forced to sell or needs to sell. It's either loan maturity, their ownership, partnership having issues, bank is putting pressure because they don't have liquidity to pay. Whatever the reason, it's got to be a good story. And then you're not trying to run volume. I mean, for us, it's one deal a quarter. Maybe for somebody else who has a big operation. By the way, our deals are not small. So one a quarter, and some of these deals are $1,000 deals, right? They're significant deals, but it's a precision, big type of high-quality deal. You could do the same thing in smaller deals. We've looked at significantly smaller deals. So we're not looking for volume. We're just looking at every deal. It has to pencil out. Even the conversations we're having with other sponsors who are bringing us deals, I ask them, why is it a great deal? I mean, tell me the story why it's a great deal. You got to be so passionate about it. You got to be salivating that you're getting, in real estate, one person's problem is another person's opportunity, and you're not trying to be a vulture, but you're trying to buy right, and that now is the time where you could get the. And by the way, I'll add one comment comes to mind. I've had this conversation so many times. People bring us ground up deals versus these existing deals, and I look at every ground up deal and I tell them, can you get a discount on construction? Are they going to build it for you for 50% off? Like, no. You can get a discount on the land, but land is 8% of the total price. So you're basically heavily speculating on ground up that when you build it, you'll get your target rents and people will pay the price you want. Or you can get it at a deep discount today and don't speculate, literally invest at a asymmetric return profile.
Wow, you're so knowledgeable on that. I learned a lot through that. Thank you. That's awesome. And I think it's really important. I think that's probably a big reason why your company is so successful is having the precision within those deals that you do. I know in your book, it's all about choosing smart real estate funds. What's a key factor that a lot of people overlook?
Yeah, that's a book from multiple years ago, right? We're working on the new book, and the new book has a lot of new interesting ideas. Yeah, those 10 factors were the multiple. I would say that every time you invest into anything, whether it's a syndication or a fund, the thought process and decision process, I'm going to start with the most important factor by far in any investment decisions. You're investing, who before how, right? You're investing with you're picking a jockey before the horse. Mm-hmm. So, especially if you're investing in a fund, you are investing in the fund managers. So you really have to get to know, like, and trust fund managers. And the difference between a fund and a syndication or one-off deal is fund, you are investing in existing portfolios, so you can actually do a little bit of due diligence of what's in the fund today. But fundamentally, you're investing in the managers because all the future transactions, all the new acquisitions will be future events, and you can't even review them. You don't know what they're going to look like.
If you're looking for consistent, high-quality leads, look no further than Investor Machine. Investor Machine isn't just another agency. It's the most sophisticated, data-driven lead generation company on the planet for real estate investors, and serves the role of being not just a lead generator for your business, but a marketing partner that is helping you achieve your goals along the way. Go to investormachine.com to learn more and schedule a call with our team today.
With the syndication, one of the beauties, you can actually look at what does it, location, purchase price, what kind of financing it gets. You could look at a lot of underwriting of a deal-specific type of review. So you're always starting with both. Jockey ahead of the horse, and you start looking, if it's a fund, what do they have in the fund? And if it's a new fund, what is the investment philosophy, strategy? How much experience does the manager have in this field? Do they have history, et cetera, et cetera? When you do syndication, of course, I look at it a lot more of why is it a great deal, and who is the operator? Do they have capacity to execute? Are they vertically integrated in that market? Do they know how to execute this value add plan? Are they conservatively budgeted and financed? So fund has a ton of other elements. Of course, you could look at the fees. You could look at the portfolio composition. You could look at the fund strategy. So they're a little different for fund versus syndication. Today, honestly, I have to say, in my personal opinion, we've heavily gravitated to individual deals because I actually want to see what's really happening. Not only as a capital partner and a raiser on a fund on a deal, it's a lot easier also for investors to grasp a one-off deal than a fund. The fund's primary advantage of a fund versus syndication is typically diversification, right? It's kind of the reason people go into funds is because they want to write one check and not bother, and there's nothing wrong with that. But the curse is also that you're not necessarily diversifying in time, although the fund may be able to diversify over time, over the life of the fund, right? There's a little bit of that element. But if you can write a check into deal 1, 2, 3, 4, 5 over time, different strategies, you can accomplish what a fund does for you with a little bit more precision per se.
I love that. And I know something that kind of sets your business apart is your deal structures are very strong and they serve the interests of various investors. Is that right?
Yeah, I appreciate that comment. We've done this in the past. We continue to do this. Is most definitely very, very relevant. There are different folks with different needs. And we work closely with investors who just want passive income and less risk. Let's just call it, they want to be in a safer position in whatever the deal. And then there are investors who are more interested in higher upside. They want to play in a higher risk position, but they also want greater tax benefits and greater economic upside. So we've done this separation of, let's just call them preferred and common equity. One of the simplest ways to compare and contrast is you could be in the equity part of the deal. You could choose, by the way, to be in the debt side of the deal. You could be a lender. You could say, hey, I want to be in a private credit. And in some deals, it's exactly that. We have syndications where we loan money and investors participate in just taking the lowest risk profile being first lien position. Some folks want to be a little more yield, a little bit more flexible, but they still want to be a lender. So it's a secondary lien or a mezz debt. And then if you go in the equity space, you could be in a pref equity. You can get a deep value buy and be in a pref equity position. So you're very downside protected because it's a great acquisition, but you don't want to take the common equity risk. And there are plenty of investors that are pretty happy with the coupon. They're pretty happy with the overall upside potential. So just give you an example for comparison's sake. So pref equity deal we did in Q1 called Waverly on the Lake. We got institutional pref equity, and they basically required 8% preferential distribution, and then we got 8% in common. Actually all payable because the deal is so deep buy. So you can pay to pref, you can pay 8 to common. Then they have seniority of return of capital.
If you're a new or newer real estate investor looking to launch or grow your real estate investing business, please check out Investor Fuel Club. It's a coaching community, but unlike anything you've ever seen before. And you can actually partner with members of our mastermind from coast to coast on deals right in your market. There's no better opportunity to build a consistent business than to literally partner with pros to help you avoid costly mistakes, avoid the need for capital to do deals, and help you eliminate your fears as you're starting your business. Learn more about Investor Fuel Club at investorfuel.com/club.
They get no depreciation benefits in pref equity, and then they get an upside to 18% return, right? So their risk profile is not that bad. They have common equity behind them. They get 8% yield, and they get 18% upside, and they're done. On the common equity, we got our 8% yield, and then we get unlimited upside, and then we get 100% of all the depreciation. So for the common equity on that deal, with Trump passing big beautiful bill and getting 100% bonus depreciation back, we're gonna get 2x for every dollar invested. So to the bonus, you invest $100K, you get $200,000 first year loss. That's pretty interesting, right? And you get your equity upside. You can wind up, if the deal goes well, you can make 25%, even higher return, right? It depends on how the deal works. But that's what we love to structure these deals with this type of difference. Now, the risk profile, of course, in common equity is higher, and people need to go there with a full understanding. You're taking all the tax benefits, but you're taking more risk. If the deal goes the wrong way, you're in the first loss position per se. Mm-hmm. So it's a trade-off. For some people, they love it. A lot of real estate professionals just want to be in a common equity and get the tax benefits. And a lot of doctors and dentists and passive income investors, I'll be in the pref equity. I want to take less risk.
Absolutely, and that's probably a good place to start if maybe it's your first time or you're just dipping your toes in it.
Yeah, I mean, it's kind of like, if you're a first-time investor, of course, you may gravitate to more conservative, lower risk. But at the same time, there are different strokes for different folks. There are first-time investors who are perfectly comfortable with a little more risk. So I wouldn't perfectly say that because you're a first-time investor, you got to be in the pref equity. Mm-hmm. I would say, hey, if you're a first-time investor and you need some tax benefits and you're comfortable with a deep value buy in common equity, that's okay too. So it's a personal set of circumstances, your own goals, your own risk tolerance. It's also kind of an age thing, right? Some people are younger. They kind of don't mind a little more risk. They don't mind. And if you are retiring and you don't want to take that risk and you are already playing with the money that you need to preserve, then you want to take less risk.
Yeah, and I'd love to hear more about, you were talking about the recent bill that was passed. I would love to hear just your take on it in general and kind of explaining more of what's going on there and how, you mentioned a little bit about the upside, but I would love to just hear more about that.
I'll give you a really short version because it's a big, beautiful, maybe it's not as beautiful, but it's a big bill. Yeah. And I literally got some guidance from our CPA article today. It's 50 pages. I'm not kidding you. I looked it up, and it told me go to page 41 to see what's the biggest impact issues for real estate. So we're still trying to dissect it. I don't claim to be a specialist. I'm not CPA. I don't play one on TV. And 50 pages from a CPA firm with the explanation of all these benefits. You need a lot of time to even understand this.
Absolutely.
But for real estate, the simplest and the most important benefit is the 100% bonus was restored and made permanent. So what does it mean? It means for these items, typically in commercial real estate, you can run a cost seg and take your short sort of life cycle schedules, your 5 year, your 7, I think up to 15 years, you could depreciate all in 1 year. So what it does, it accelerates all that and gives you massive tax benefits. There are some other pretty interesting provisions on opportunity zones. There's been some extension of that. There's been a number of other extensions, but the direct biggest impact, I think it's going to cause many investors on sidelines to start taking action, looking to acquire commercial real estate, especially now when the valuations are depressed. Now, we don't know that. There's still going to be vultures and people are still going to look for great deals, but it's going to feel like a massive tailwind. And the other thing that probably will be really good tailwind, again, crystal ball discussion. I can't, I don't know what's going to happen. But sooner or later, we're going to get these interest rate cuts too. That's been sort of delayed. Jay Powell and Trump are going at it. At the end of the day, Jay Powell's term is maturing. Sooner or later, Trump is going to get his way, and we're going to see some rate cuts. Probably Powell will start, and then whoever Trump will appoint next is probably going to really accelerate those. So it feels like, from multiple things I heard and I read, and we're going to have yield curve steepening. The Fed funds rate influences the lower end of the yield curve. Those rates going to come down meaningfully over the next, let's call them, year and a half. They may not start super fast because Powell is sort of a little bit offended by Trump. Nonetheless, he's still going to probably do some of it. And then we're going to see reacceleration, and that'll be significant tailwind. So without spending a ton of time on all other provisions and extensions, and there's a provision for REITs, 20% QBI, and other things that are just extended. A lot of it is kind of been around and it existed. But the reason 100% bonus depreciation is so important, it was phasing out and it was at 40% now. 100 versus 40%, it's 2.5x delta. So that's a big difference, huge incentive. People are motivated now to act, and I feel that that's going to give us some really good tailwind.
Yeah, that's awesome. I mean, you break that down so well. And the reason you're so well spoken on all this is because you have your own podcast as well, which I would love for you to talk about so we can, have some people interested in that as well.
Kristen, you're too kind. Yeah, it's a podcast with a cheesy name. People call me Big Mike, and I'm a fund manager, so it's Big Mike Fund Podcast, and people can find it at bigmikefund.com. And if you misspell it, you forget the D at the end, and you just go to bigmikefund.com, I promise it's not a kinky site.
That's funny. That's awesome. And then where else can people find you? Are you on, social media? Do you have a website for your business?
Yeah. So you could actually get that website is a great entry point, bigmikefund.com. You can click from there to our corporate site. You can listen to the podcast. I just like to put it, if you're bored, you got nothing else to listen to. That's the podcast, and we're working on the new version of the podcast. That podcast, I interview folks like you, wonderful, great folks who have a lot of ideas to add. It's mostly all around real estate, although I've had guests who are just great economists, and they talk about things outside of real estate. But our corporate site is tempofunding.com, from the word temporary, TMPO, tempofunding.com. And but go to bigmikefund.com, start listening. We have a YouTube channel, we got social media. You hear my conversations, but the next version we're looking to add, honestly, you're the first person I'm mentioning to. But I've been listening to the All In podcast. I don't know, for those of you who have seen that podcast, brilliant podcast, and I'm very obviously inspired by those folks. So we're thinking to do something similar, bringing in maybe 3-4 permanent leaders of the space. And so instead of a one-on-one discussion, it'll be maybe 4 voices. And we'll see. I mean, I don't know exactly, but we're brainstorming who to bring in and how to make those discussions exciting and how short to keep it. Because honestly, these conversations can go on for an hour and a half and get a little too long, but they're great discussions. So.
Yeah, I mean, that sounds great. I would listen to that for sure.
We'll see, but for now we do have great episodes at bigmikefund.com, and then if we have a new version of it, we will certainly promote it the same way. And it's a journey, it's an evolution. It's kind of like if you're having fun, you're doing it. I just said this for all the audience. This is very important. It's important to me, and I think it should be important to everyone. Every time you encounter anything in life, any task, any opportunity, anything, I think of as, are you in your genius zone dealing with it or working on it? And what the hell is a genius zone? Right? People talk about three things, right? Something that you're really good at, something you're very happy to do, you're very engaged, so you love it, right? And then it's got to be also economically profitable or feasible or successful. So the combination of those three things, you're very good at, you make good money, and you love doing it, is what puts you in a genius zone. So everything else should be, it could still be great, but if you don't make money and you're good at this, you really enjoy it, it's called a hobby, right? So people have a lot of hobbies, but they don't make any money and just spend money doing them. So, but the moment you can get also your success factor, before you know, you are now in your genius zone, and you are suddenly in an extra gear. So that's my feedback to anyone. Always think, can I be in a genius zone? If you are, work is not work, it's fun, you're really enjoying it, and you're making money, and as you're doing this, you're gaining more and more experience and expertise. So that's it.
I love it. Well, thank you so much for sharing so much and, explaining some of the current events going on. This has been awesome. So everyone go to bigmikefund.com. And yeah, hit the subscribe button if you like this podcast. But thank you so much, Mike. This has been awesome.
Thank you, Chris.
Thanks for joining us for today's Real Estate Pros Show. You can learn more about the amazing benefits of the Investor Fuel Mastermind community, including surrounding yourself with hundreds of other rock stars, 100% financing for your deals, and members-only discounts from vendors you're likely already using that, as a member of Investor Fuel, will save you more than the cost of your membership. Visit investorfuel.com to learn more. If you're interested in joining us as a guest of this show, please visit investorfuel.com/pros to apply. You can also check the show notes for access to free resources, how to get access to world-class lead generation, and much more. Don't forget to subscribe so you never miss another episode. Have a great day. We'll see you on the next show.